we have an advantage actually as individual investors to create more flexible positions, because generally our positions are going to be a lot smaller than the hedge funds. Hedge funds have to come in with millions of dollars of stock options and purchases, and they have to negotiate with banks and other investment companies in order to put on their trades. On the other hand, we can go in, we can buy 100 shares of this, 1,000 shares of that, 100 shares of this, 500 shares of that, and then hedge them with index options like the Qs in order to hedge our entire portfolio. Now what's happened to our position? Well, now we have a maximum downside risk of about $400 by buying the Q put options for July against these 300 shares of our stock. It gives us a good deal of downside protection as well as unlimited upside protection, which is what we're looking for. So, you know what? Our delta is 157. So, you know what? It's a little bit strong. It's a little bit, it's a good delta if the stock does move up. If all of our stocks continue to move down, then we don't have quite as much protection. On 300 shares, we may have to adjust this up a little bit. Just maybe buy 4 contracts for our 300 shares in order to get to a position where you feel comfortable. So in other words, our maximum loss here is going to be about $583 if the stocks we picked do not move, or the QQQs do not move. And if our stocks go up, yes, we do have unlimited upside potential. And actually, if we get hit with a really bad bear market and all of a sudden our stocks go down, well, our Q position is actually going to make money for us and act as a hedge against our long positions in our stocks. This is the way, like I said, hedge fund managers and professional investors manage their stock positions. They don't, just like we did with our option positions in our monthly income trades, we look at the numbers. We trade by the numbers. We take a look at our delta. We take a look at our, we take a look at primarily our delta position, but we also take a look at our profit and loss over time. We are hedging our stock positions based on portfolio-weighted QQQs, and then purchase the number of Q puts to help protect the downside of our stock position. Let's say if we take that out, you can tell that if we take those Qs out and we did not buy those puts as protection, yes, we still have unlimited upside risk, but we also have almost unlimited downside risk. I say almost unlimited downside risk because the stock can't go below 0. But if it does, in fact, if our stocks do go to 0, we'll have lost a maximum of our investment, which is about $13,800 in these 300 shares of these 3 different stocks. So hedging, as you can tell, is a very, very good investment. It does limit your, it does put a little bit of a limit on your upside potential profit. However, that is a price well worth paying as insurance, because you also have a very nice downside protection. The only thing that you have to be concerned about at this point is that your stock's not moving at all. Now, what can you do? Well, you know what? You can do the same thing. If your stocks go down, you can do the same thing that you were going to do on each individual one of these positions. Let's say the market just fell apart and all of a sudden dropped a few thousand points. The QQQs went down to extreme levels, and we lost about 10 or 15 points on the Qs. Well, you take those profits and you would reinvest it maybe in another 50 shares or 50 shares of that or 50 shares of that. You can divide it any way that you want, but use that insurance policy that you cash in if the market goes down in order to purchase more stock, so that when it does go up, you'll be in a really nice position and you've added shares to your position that were basically free. I mean, basically because you purchased that put option to begin with, you have no more you don't have to take any more money out of your pocket in order to buy additional shares of the stock.